Welcome back to our intermediate financial accounting class. We've been talking about inventory, what it is, why it's important, how we need to be able to understand it, to track it both as internal accountants and as external stakeholders. We then did some fun examples of calculating cost of goods sold and figuring out what an error in inventory will do to our net income. Now it's time to talk about more specific ways that companies track their inventory costs. And the first thing we need to talk about is what costs should be included in our inventory values. Really, all product costs should be included in our inventory. Now, product costs comes from a cost accounting concept. It's the idea that we can break down all the costs in our business into those costs associated with production, product costs, and those costs associated with everything else we do. Period costs or selling and administrative costs. So the idea here is that anything we spend on production should become part of inventory. And this really has three parts. There's direct materials, direct labor, and manufacturing overhead. And you probably remember these concepts from your first managerial accounting class. Just as a quick refresher, direct materials are the raw goods that we use in our production process. Direct labor are the costs of the individuals directly on the line making the good. Overhead are all the other costs associated with keeping our factory open and running. So security, maintenance, depreciation, rent expense if we have that on our production facility, line supervisors, the plant manager, all of this stuff becomes manufacturing overhead. And we take all that overhead, we add it up, we allocate it out to our production costs. How we do that, I leave to a cost accounting class, but that's what we're talking about in deciding what to allocate to inventory. Now, if we're not a production firm, if we're a merchandising firm instead of a manufacturing firm, then this becomes really easy. The product costs are what we spent buying the product, and that's it. Really straightforward. It becomes a little bit hairier when we're a production company or a manufacturing company, and we have to keep track of all these different pieces. Good rule of thumb, though, if it happens in the plant, it's probably a production cost. If it happens in an office building, it's probably a period or selling and administrative cost, and we wouldn't include those in our inventory value. There are a few unique issues that I want to mention specifically that have some very specific rules. The first is that interest costs are never product costs. So even if you take out a short-term loan to help you buy inventory, you can't put that interest cost into inventory. It has to be treated as a period cost. Purchase discounts, that's the second thing. We don't include purchase discounts as inventory value, so we might initially put into inventory and accounts payable what we have to pay, or what the sales price is on these units. But if we then qualify for a discount, we'd reduce our cash and reduce inventory, and that would keep things in balance. So that's what we're doing with purchase discounts, is we're taking it out, not including it in our inventory value. The last thing are variable costs, and variable costing again is a cost or managerial accounting idea. It's the value of any one unit. So for every extra unit I produce, I pay that much more. So this is my cost, and this is my number of units. This is my per unit cost. And over here, if I do my total costs, variable costs look like this. They start at 0 with no units, and every unit I sell or produce goes up by this amount. That's what a variable cost is. That's just a quick refresher on the concept. GAAP does not allow us to use variable costing for inventory values. We use it all the time in cost accounting, and it's a very helpful decision-making tool, but you can't use it for GAAP. So just be aware, even if you've got those numbers, don't use them. We have to keep track of all product costs, not just the variable ones. Now, within this wide category of tracking inventory, we have lots of different methods that people have come up with. The first and most straightforward, I guess I would say, is what we call the specific identification method. This is for companies that make a very few, usually high-end units. Since I don't produce much, I can keep track of every single inventory item. Think about a construction company that makes large homes, mansion style, or that produces buildings for businesses or universities. So they have maybe 2 or 3 buildings going at a time, and they're huge. I can keep track for each of these items, all the materials going in, the labor going in, the overhead I want to allocate, because I have just a few really big items that I'm tracking. Same thing if I'm making high-end jewelry, or I'm making really specialized equipment like a yacht, or really specialized manufacturing equipment for a company. That is easy to track with this method. The good part of the specific identification method is that I know exactly what I've spent on any given unit. I'm not estimating, I'm not allocating, I just know. I've been tracking these costs, I know exactly what I spent. The bad side or flip side of this is that I can easily fudge those numbers because there's just a few items, and if I'm starting to get over budget on this project, I'll just shift some overhead over to this other set of products or this other big product. So the negative side of this specific identification is the fact that it's easy to manipulate. Before we move on to the next method, let me take just a second. We're going to talk about pros and cons of each method, and those pros and cons are another one of our key concepts because it's so important to understand the different methods and why we might or might not choose them. With that warning or invitation to pay attention, however you want to say it, let's move on to our next 3 methods. Now these methods are for mass production. We might like specific identification, it makes sense, but it just is not possible to track the cost of every Cheerio that I produce or every pencil eraser. It's just, there's just too many of them, it's just not worth it to try to tag costs to each specific piece. So we had to come up with some other methods that we could use that would allow us to allocate to mass quantities, because that's the way a lot of production is done nowadays. The first of these methods is the weighted average method, and the pro of weighted average is its simplicity. I add up all of my costs, I divide by the number of units, that's the cost per unit. So it's really simple. The negative of this weighted average method is that there's no attempt to keep track of specific purchases or specific sales. It's just kind of this big hodgepodge. The other thing I'll mention about weighted average is it's one of the methods allowed under both US GAAP and IFRS. And finally, the last pro you can see down here is that it's a moderate method. It kind of takes out the extremes of the 2 other methods that we're about to talk about. The first of these other methods is FIFO. And you probably have heard of FIFO and LIFO before, so we'll just touch on them briefly. FIFO means first in, first out. So we're assuming that the first unit I bought is the first unit I sell. And the best way to think about FIFO is a grocery store. If I'm selling loaves of bread and I get a new shipment, I go to my shelf, I push the old bread to the front, I put the new bread in the back, because if I let the old bread get pushed to the back, then it goes stale or it gets moldy. So I want to make sure that I'm cycling it forward and selling the oldest stuff first before it gets destroyed. So that's the FIFO system. And most companies, we tend to think, use a FIFO system as opposed to the next group, which is LIFO. So as far as FIFO goes, there's a very good tracking between the value in our ending inventory and what we're currently paying for those units. So our asset values look really good. Another pro of FIFO for most people is that this is how we probably sell our units for most companies. So that's considered a pro, is that the tracking is more accurate. The con of FIFO is the fact that even though our ending inventory matches up with what we're paying, the cost of goods sold is lower because I'm selling off the cheaper stuff traditionally first, and as costs inflate, then that's what's going into ending inventory as opposed to going into cost of goods sold. So that's the biggest negative of FIFO. The other plug we'll put in here, and we'll show it again later, but FIFO really gives the same value whether you use periodic or perpetual, and that makes it really easy to make some of these calculations if you know that those 2 numbers are exactly the same. Now LIFO is last in, first out, and this is the assumption that I sell the stuff I just recently bought first, and the old stuff just kind of gets shoved to the back and isn't ever really sold. It just kind of sits there. Now for most people, the biggest con of LIFO is that they don't think this is the real flow of inventory. But there are examples of companies where really LIFO is the way inventory flows through their business. For example, technology sales. People want the newest units, so they buy the newest units. As a new iPhone or iPad comes out, people buy that one and they stop buying the older stuff. So it has to be deep discounted, it doesn't move as fast because I start selling immediately the new stuff. Another good example is when you gas up your tank. Most of those tanks siphon from the top, which means if I've got a tank of gas, I pour new stuff in as I get another shipment, that gets siphoned off, and really the older stuff does kind of settle to the bottom. Now it mixes a little bit, but that idea that I'm sucking from the top instead of from the bottom means that it really is following a LIFO flow. And if you think about it, there are other good examples of inventory flows that really do follow LIFO. Now, the biggest benefit of LIFO is probably the fact that our cost of goods sold is most accurate, because since I'm selling the stuff that I've just recently purchased, or that's my assumption, then the recent costs are what end up in cost of goods sold. So cost of goods sold matches up really well with our replacement value. Ending inventory, on the other hand, does not match up well, and this is one of the biggest cons, or the other big cons, is the fact that ending inventory doesn't look at all like what I'm paying for the units, because it's all this old stuff that gets stuck in ending inventory. So that's really the biggest con. Now, LIFO in the United States has become really, really popular, and the reason for this is because cost of goods sold is higher. What happened is a lot of companies used to keep two sets of books. They'd use FIFO for GAAP and show this low cost of goods sold, high ending inventory, so that they'd get a good net income number. And then for tax purposes, they would show LIFO, and they'd have this big cost of goods sold number that would reduce their profit, so they'd have to pay less in taxes, and they'd have a low inventory value, which didn't matter for taxes because you're taxed on profit. Well, the IRS finally got wind of this and said, you can't do that anymore. You have to use the same method for both. So LIFO really has become very popular in the United States because it turns out that tax benefit is more beneficial than the net income benefit or the profit jump that you get from FIFO. So because it's so popular, we've come up with a lot of different specific ways to use LIFO in the United States. The most common is what we call specific goods LIFO. And that's where we track each item individually as it's purchased, or each class of items. So each type of shoe, each type of shirt, we keep track of each inventory item separately, and we track our LIFO that way. This usually results in really big, what we call LIFO layers. You know, I'm buying these units at $8 now, I'm going to buy them at $10, then $15 or whatever. Those $8 and $10 stay in my ending inventory, and each one creates kind of a layer of this old inventory that's never being sold. And this specific goods LIFO tends to exaggerate this layers problem. In order to kind of offset that, we came up with specific goods pooled LIFO. This is where we keep track of groups instead of individual items. So all of our hiking boots, all of our gym shoes, all of our t-shirts, all of our more formal shirts or polos, etc., they get grouped together. And the idea is, if I treat all of my shirts together, or all of my shoes together, or this kind of shoe versus that kind of shoe, then as the different prices fluctuate, this one goes up but that one goes down with sales, then they offset and I don't get these big pools or layers. The other common version of LIFO is what we call dollar value LIFO, and this is where we treat all of our inventory as one big pool. It's usually much faster once you get the hang of it than other LIFO methods, because I'm not tracking each individual unit or each group of units. I'm keeping track of everything all at once. It does take a couple of times through to really feel comfortable with dollar value LIFO. Now, last concept that we need to talk about here is the fact that no matter which version of LIFO you use, each one is different from FIFO. Usually what we see is a pretty significant difference in cost and inventory values between FIFO and the LIFO method you've chosen. And this results in layers. To show what I mean with these LIFO layers, assume that we bought 100,000 units at $10 each. So we have $1 million in our inventory. Then we buy another 100,000 at $12 each. And then we buy another 100,000 the next year. This is what's in our inventory. These are my layers. This is what I was talking about. So I've got all this inventory. This is what I'm paying now. The $15 is what I'm paying now. So I've got in my inventory all these old goods, supposedly, that are still just sitting there. The concern here is the fact that, you know, if I'm having a bad year and prices jump up to $18 per unit, I could stop buying units. not only would I save the money that I'm not spending, the $18, but I could liquidate through these layers and start selling a bunch of units now at $10 each. And all of a sudden, my inventory value is dropping, but it wasn't that high in the first place. More importantly, my cost of goods sold is dropping. And it's a way that companies could, intentionally or not, improve their net income. And there was a big concern with this. And so what FASB finally said was, look, you have to show the difference between LIFO and FIFO so that investors can look at this and say, okay, what are the layers? What could you possibly be doing here to mask your true net income by hiding it through liquidation of layers? So now we have to record this LIFO reserve, which explains the difference between the two methods. Wow, lots of conceptual stuff. Hopefully you feel comfortable with the different methods, at least conceptually. When we come back, we'll be actually running through an example and seeing how all of this comes together to change what we see in inventory. I'll see you then.